As Steve said, I'm Angie Quigley. I've been with the firm for 9 years. I'm going on my 10th year. I am a manager in our Chambersburg office, but I service a lot of the other offices through the research and experimentation tax credit. I am a graduate of Penn State in 2010, and I am a trusted advisor to tax and small business clients. A couple of things that I'm going to talk about today. I'm just literally touching the surface on the R&E credit. I'm going to talk about what the credit actually is, talk a little bit about what qualifying activities your company could have, and then also talk about the qualified expenses associated with those activities. And then I have a couple of industry examples as well. So to get started, how many of you know about the R&E credit? Okay, a few? All right. So as you know, this is a gift the IRS is giving taxpayers to encourage innovation. It is a dollar for dollar credit, and basically all you have to do is innovate, right? Sounds easy. It's been around since 1981, and since 1981 up until the PATH Act of 2015, it has always been a temporary credit. So a lot of companies, they didn't really want to invest in it because there's a lot of documentation that goes into calculating this credit. That first initial year that you take the credit is usually the most painful, and then beyond that, it gets easy because you're setting up a lot of your assumptions in that first year. You're doing a lot of education in that first year. And then after that, it's kind of like riding a bike, right? Once you have everything set up in your system, you're tracking it properly, you can calculate the credit quite easily. The PATH Act of 2015 changed the game for this credit, and it actually made it more common for companies to actually apply for it. The IRS had said, okay, with it being temporary, there's billions of dollars being left on the table. So they wanted to give people the option to be able to take the credit. So they made it permanent and started in January 1st of 2016. When it became permanent, they also lifted the AMT restrictions. So a lot of the companies who were taking the credit prior to the PATH Act of 2015, they would be eligible for the credit, but then it would be limited by AMT taxes once it got to their individual level. So they didn't actually get the refund. And that upset them. So they're like, why do I calculate a credit that I'm not going to be able to take immediately? Now the credit does carry over for 20 years, but if it's always limited by that AMT, they may never qualify for it, and it might expire. So once that was lifted, it made it a little bit more enticing for companies to actually apply for it. So the R&E credit, like I said earlier, it encourages innovation, but really what it is it's a credit awarded to companies who have new or improved products, processes, techniques, formulas, or software. One of the things that the PATH Act of 2015 did for small businesses, so small startup businesses, so if you're in your first 5 years of operation, you're in year 1 through 5, it allowed you to be able to take up to $250,000 of the credit and apply it against payroll taxes. So what that meant is small startup companies typically have lower income in the first couple years. Most of the time they're operating at a loss, sometimes just break even. So they don't really have taxes to be able to claim this credit, but they have to have out-of-pocket expenses for someone to calculate this credit. The IRS had said, well, we want these companies to be able to qualify for the credit, and we want them to take advantage of it and have cash in their pockets to actually put back into their business and invest in another product or keep growing. So they allowed companies in the first 5 years, if you have less than $5 million of gross receipts since the year 1 within the first 5 years, you can claim up to $250,000 against your payroll taxes, which was pretty cool for startup companies. The research credit has some strict rules on what qualifies, what activities qualify for this credit. So you have to identify qualified research activities first. And then once you have the activities identified, you have to identify the qualified research expenses that are associated with those activities. So the IRS has a 4-part test in what activities would actually qualify. So 1, it has to be for a permitted purpose. So it has to actually have some type of increased functionality or reliability or a change in functionality or reliability. How I explain this, the best example I can give for this is actually talking about bigger items, because then you can visualize it a little bit better. So I have a Toyota Tundra, and in the back seat of my Toyota Tundra, the bench seat, on the passenger side, there's about a foot space of like storage under the seat. And then if I get in behind the driver's side, there's about 4 feet of space that's storage under the seat. So if I went to the manufacturer and I said, I want that switched, because where I park, how I park, most of the stuff that I need access to, I'm going to do that from the passenger side. And I want that bigger storage from the passenger side. So the manufacturer's like, sure, I can do it. So they switch the seats, the smaller ones now on the driver's side, the bigger ones on the passenger side. Does that change the functionality or reliability of the truck? No, right? So that activity, them doing that, doesn't qualify, all right? Now, let's talk about an aircraft, right? So if I go, I'm rich, right? I go and I ask for one of those puddle jumpers, and I know that I'm going to take it down to Florida in the morning and come back from Florida in the evening. So I want most of my passengers that I take with me to see the prime view of the sunset and sunrise, right? So I want 2 seats on the right, 1 seat on the left. So I go to the manufacturer and they have it the other way around. They have 2 seats on the left and 1 on the right. And I'm like, no, I want it the other way, right? So the manufacturer's like, yeah, sure, I can do that. What does that do to the reliability? Does that qualify? Does that change the reliability and the functionality of that aircraft? Yes, it does, because an aircraft relies on weight distribution. So by changing the seat, you're changing the weight distribution. And now the manufacturer has to go through testing. Most of the time they know they can do that change, but they're still not sure what it does to the aircraft. So by just changing the seating, they now have to run tests, make sure it's going to fly okay, make sure it's going to stay up, and make sure you're not going to crash on your first flight. So that's kind of a brief explanation of what the permitted purpose is. There has to be, it has to be technological in nature. It has to apply some type of a hard science. So it can't be like the soft sciences, the touchy-feely psychological type changes. It has to be chemical changes, mechanical, something hard, right? So a couple of the other parts of the test, I kind of touched on it when we were talking about the airplane example, but there has to be a process of experimentation. So testing has to be involved, whether it's robotic testing or whether you're doing trial and error, whether you just have somebody actually take a prototype and use it to see if it works. But there's some type of process of experimentation. And then you have to eliminate uncertainty. So by making the change, by improving a product, you're not really sure if it's going to work. You think it's going to work, but there's still testing that needs to be involved to eliminate that uncertainty. So as long as you pass all 4 parts of those tests, you could potentially qualify for the credit. Now, I like to add 2 others, because if you read the audit guide, they have 2 questions on the audit guide. When an auditor comes in to see if you can take the credit that you just claimed, there's 2 questions that they ask. One is, do you own the intellectual rights to the property that you're claiming the credit on? If you own the intellectual rights to the property, then you can claim the credit. The second one is there economic risk with taking that credit, right? And I'm going to explain that after I talk about qualified research expenses. So once you identify the qualified research activities, you then have to go into the qualified research expenses. And those are wages, supply, and subcontractor wages. Basically, time and material. So when I talked about economic risk, kind of jump back a little bit on that. If your contract states that you are going to be, so someone comes to you and says, I need this item, I don't care what it costs. I just need it, and I want you to do it. So I'm going to reimburse you time and material. You don't qualify for the credit because you're getting reimbursed time and material. There's no economic risk, right? The contract states, I'm going to do this product for you, but I'm going to charge you $10,000. You don't really know for sure if your costs are going to be within that with an appropriate margin. You think, based on past experiences, you should be okay, but you might get into something and it causes a little bit more headaches, so you have to do more testing, and then you're up to $12,000 of cost. If you can't go back to that customer and say, can you reimburse me for that change, then you probably do qualify, right? Because there's economic risk with that contract. Doesn't necessarily, if it's not stated, it's assumed that you have economic risk, right? All right, so here are some of the common industries benefiting from the R&E credit. As you can see, manufacturing's on there, but there are many other industries: agriculture, architecture. Engineering firms are a little tough because a lot of times they don't own the intellectual rights to the property that they're actually designing. If they do, they could qualify. Food and beverages. We actually picked up a lot of breweries, and they qualify, especially that first batch that they do for any new drinks. Pharmaceuticals, that's a huge one because they're constantly designing new products, improving improving old products. Even like tooling, a lot of companies who do tooling, they don't think that they could qualify because a lot of times it's a volume type business. But when they're designing that new tool, or if they're changing the size of it and they have to do testing, that's when they would qualify. So in 2016, I don't have an updated number on here. I actually checked last night just in case. These are the numbers that were claimed. So $9 billion of R&E credits were claimed in the manufacturing industry. I am nearly 100% sure that number is much higher today because 2016 would have been the first year that the credit was made permanent. So there's a lot more companies taking advantage of it today. But as you can see, manufacturers are claiming 61% of the credit. But it doesn't mean, I think it's just that the other companies just don't know that they can claim it, right? All right, so in your packet, I actually have some of these examples. I'm not going to touch on all of them for the sake of time, but streamlining manufacturing processes through automation. Later today, you're going to hear about lean manufacturing. So if you're not currently using lean tools and you change to use lean tools, that could potentially qualify because you're increasing yield times by just changing some of your processes internally. Designing and developing new products that would qualify as well. Companies that design or bring on equipment to increase their production flow, a lot of times that would qualify. Again, if there's a testing involved in that. I have a company, it's actually down in Tennessee, that I helped out. They had an internal staff actually develop a system where they were testing this product one at a time. So their internal employee actually designed this tool that they could put 3 of the product on this testing unit at one time and test 3 at a time. So just by designing that, they used it internally, but it still qualified because it increased the time that the quality control could get products through their unit. The other thing I didn't mention earlier, and I wanted to, was this credit. A lot of people think that it needs to be a new to the world item to be able to claim this credit. It doesn't. It just needs to be new to you. So if somebody down in Florida is doing this and you're like, man, that's cool, I want to do it here, and you design it here and you go through the steps, you go through that 4-part test, the testing, then you could qualify for the credit, even though that product might be out in the world, right? All right, so what can SEK do for companies? First of all, we do a courtesy analysis. So we're not going to come in and be like, oh, you qualify for it, and then charge you if you don't qualify for it, right? So we do a courtesy analysis. We do a lot of conversation. Do you qualify? What type of activities do you have? We do a lot of education. How can you document better? How can you move forward better? And then that way it makes it easier even for the calculation processes. We do a study. So it's an audit defense. If the auditor comes in, obviously adding anything to your return from just a basic return creates risk. So in order to minimize that risk, we create an audit defense for you. And then we also provide consulting. I actually did it twice for 2 different companies now, where they've been calculating this credit for years, and they were like, I'm not sure if it's calculating properly. So just going in, looking at how they're calculating it, look at how they're reporting, making sure that they understand it. If you have a change in staff, you have to make sure you're educating the new staff on what they're doing so they can document their time appropriately. So that's everything that we do to make sure that you're compliant.